Did you know the top 1% of traders predict market moves with eerie accuracy? Are they psychic? Or using a hidden psychological edge? They seem to read the future before it happens. This is not magic. It is refined psychology. Reading the market's mind. Have you ever watched a top trader and wondered if they have a sixth sense? They anticipate market turns with an almost supernatural ability. It can feel like they are reading the future, predicting price swings before they happen. But this is not a psychic gift bestowed upon a chosen few. It is a deeply refined psychological skill set. They are not looking into a crystal ball. They are looking into the minds of market participants. They understand one fundamental truth. Markets are driven by people, and people are driven by emotion and predictable thought patterns. This is the core of their edge, what we call predictor psychology. In one line, understanding and leveraging human behavior within financial markets. The unfortunate reality is that a vast majority of aspiring traders do not find lasting success. The reasons are simpler and more personal than people think. It is not usually a lack of a good strategy or a powerful computer. Most fail because they lose the battle with their own minds. They are ruled by powerful, primal emotions. Fear causes early exits on minor dips, missing the larger move. Greed pushes over-leverage or holding winners too long until profits evaporate. FOMO triggers chasing trends, buying high after smart money already positioned. Momentum reverses, leaving them holding the bag. Then comes revenge trading. Impulsive bets to win losses back. A direct path to a depleted account. Undisciplined, reactive decision-making. One foundational skill of a great predictor is highly developed pattern recognition. Beyond head and shoulders or double tops, it is perceiving subtle, repeating sequences of behavior in price and volume. Great traders train their minds to see setups develop in real time. They identify a market's unique fingerprint as energy builds for a significant move, whether low volatility consolidation or repeated failures at a key level. It is seeing the cause before the effect. This skill is not innate. It is cultivated through thousands of hours of focused practice. Review historical and current charts with a purpose. The psychological story behind price action. Where were sellers trapped? Where did buyers lose confidence? Over time, the brain becomes a parallel processor matching live markets to stored scenarios. Not fortune-telling, statistical and behavioral analysis done fast. Price action plus volume and sentiment leads to a specific outcome 70% of the time. Beyond recognizing market patterns, top traders master their emotional landscape, emotional intelligence. It is the ability to identify, understand, and regulate feelings in the heat of the moment. They know the difference between a true signal and an impulse driven by anxiety or greed. They feel FOMO, but choose not to act on it. They experience the sting of loss without succumbing to revenge. Separating feeling from action is a cornerstone of professional trading. It is not about becoming a robot. Emotions are valuable data points. Fear may signal position too large. Euphoria warns of overconfidence. Treat emotions as advisors, not dictators. The plan makes the final call. Rigorous discipline and rules-based systems, entries, stop-loss, management, created when calm, executed under fire. The third crucial skill is two-part. Control your biases, then identify and exploit the crowds. Confirmation bias seeks information that agrees with you. Great traders actively seek opposing viewpoints. Ask, why could this fail? Anchoring to entry price. Recency bias overweighting the latest move. Structured systems and checklists combat both. Apply strict risk. Cut losses at predetermined prices. Reading market sentiment gauges mood, bullish greed or bearish fear, via headlines, social chatter, and indicators like the VIX. At extremes, dominant biases drive the crowd. Reversals can be near. The crowd is rarely right at emotional peaks. When everyone panics and sells indiscriminately, prices can undershoot fair value, maximum opportunity for the calm buyer. When the public is euphoric, smart money often quietly sells. Be skeptical when others are certain, and brave when they are terrified. That contrarian skill enables buying low and selling high by trading against herd extremes. One legendary example, George Soros's 1992 bet against the British pound, the man who broke the Bank of England. Britain's ERM membership required keeping the pound within a narrow band against the Deutsche Mark. Soros saw a flaw, political pride clashing with economic reality as the British economy struggled and the pound was overvalued. Leaders were anchored to a strong pound, ignoring mounting evidence, classic institutional confirmation bias. He knew market forces would overwhelm political promises. The dam would break. He did not just see the pattern, he acted with immense conviction, building a massive short position. The Bank of England spent billions defending the pound, but selling pressure was relentless. On September 16, 1992, Black Wednesday, the government capitulated, withdrawing from the ERM. The pound plummeted. Soros reportedly made over $1 billion in a single day. The lesson: identify where powerful actors act on bias over logic, understand the breaking point, and have the discipline to exploit it. Better prediction comes from understanding human behavior, emotions, biases, and sentiment, not just staring at charts. The real edge is discipline, self-awareness, and continuous learning. What is your biggest psychological challenge in trading? Share in the comments. For more deep dives into the human side of finance, hit subscribe, turn on notifications, and like this video. See you in the next one.